So far, we've built the foundation of accounting. We learned about the accounting equation, how debits and credits track increases and decreases, and how account balances show us the totals in each account. Now that we know how to record and organize transactions, the next step is to put all this information together into reports that people can actually use. Those reports are called financial statements. Financial statements are the final reports that summarize all of a company's financial information. The balance sheet shows the company's position on a specific date, what it owns, what it owes, and the owner's equity. The income statement shows whether the company made a profit or a loss over a period of time. The statement of retained earnings explains how much profit was kept in the business and how much was paid out as dividends. And the statement of cash flows shows where cash came from and where it went, whether from operating, investing, or financing activities. Together, these four statements give us a complete picture of the company's financial health. Here we see how the financial statements are prepared and how they connect to each other. We start with the income statement, which shows revenues of $6,100, expenses of $1,700, and a net income of $4,400. That net income flows into the statement of retained earnings. We begin with $0, add the $4,400 profit, subtract $200 of dividends, and end with $4,200 in retained earnings. That $4,200 then appears in the balance sheet under equity. On the balance sheet, assets total $40,400, liabilities total $6,200, and equity totals $34,200. Notice that the accounting equation holds true. Assets equals liabilities plus equity. Here we see the final statement and the statement of cash flows and how it connects to the balance sheet. On the balance sheet, we see that cash at December 31st is $4,800. The cash flow statement explains how we got there. From operating activities, the company collected $6,100 from clients and paid $5,100 in expenses, leaving $1,000. From investing activities, the company spent $26,000 to buy equipment. From financing activities, the company received $30,000 from owners and paid $200 in dividends, leaving $29,800. When we add it all up, cash increased by $4,800, which matches the balance sheet. So the statement of cash flows answers the question, where did our cash come from and where did it go? And it ties directly into the balance sheet. There are two ways businesses can record revenues and expenses. Under the accrual basis, we record revenues when we deliver the product or service and expenses when they happen, no matter when the cash is exchanged. Under the cash basis, we only record things when cash actually changes hands, revenues when money is received, and expenses when money is paid. So the difference is timing. Accrual looks at when the work is done, cash looks at when the money moves. On the accrual basis, $100 of insurance expense is recognized in 2019, $1,200 in 2020, and $1,100 in 2021. The expense is matched with the periods benefited by the insurance coverage. On December 1st, 2019, Fast Forward paid $2,400 cash for a 24-month business insurance policy. Using the cash basis, the entire $2,400 would be recognized as an insurance expense in 2019. No insurance expense from this policy would be recognized in 2020 or 2021, periods covered by the policy.